I've been given around about 30 minutes or so to talk to you today and offer our outlook for the global economy. So I thought I'd use the time to reflect on the impact that, of course, COVID's had in terms of the global economy, consider the long-term consequences of the fiscal response, give you some of our key economic forecasts for the year, but also pick up on some topics I think will be interesting that's likely to shape the year during the course of 2021 and perhaps even beyond. So we'll be looking at what we can expect from the Biden administration, of course, the ramifications of the Brexit deal, if I want to depress you even further, and then also consider the economic outlook for the US, for Europe, the UK and China, and perhaps conclude by looking at the composition of the post-COVID world. What we do know is, of course, the coronavirus had the most profound impact on society and the global economy since World War II. The locking down of economies has resulted in this record drop in activity, surging unemployment, permanent losses in terms of output, and of course, temporarily slower potential growth. The OECD estimates the damage to the world's major economies has been 4 times greater than the 2009 financial crisis. The controlled lifting of restrictions, as we saw, did help to, I think, alleviate some of the economic pressures. Remember, a number of economies registered robust growth and a rebound in activity through the course of the summer. However, surges in infections has triggered further restrictions, which has weighed on activity in the end of last year, and of course, the beginning of this year. As a result of the disruption, the global economy shrank by somewhere around about 3.5%, as we know, during the course of last year. To put that in some sort of context, that's the deepest contraction that we've seen since the Great Depression. We do know the fiscal response has certainly been key, and there will be some long-term consequences to those actions. The scale of the hit to the economy encouraged central banks to slash interest rates to new lows, inject unprecedented amounts of liquidity into the financial system. Governments have embarked upon an extraordinary fiscal response, such as allowing companies to furlough staff, as well as pledging vast sums in loans, grants, and credit guarantees. As the true impact of the crisis has developed, so has governments' willingness to ramp up those measures to deal with the damage. The IMF forecasting that total has now surged to almost 12% of global output. So I think governments have found innovative fiscal solutions, but we should recognize they've come at a price. The IMF estimates that sovereign debt in advanced economies will rise by a staggering 20 percentage points to 125% of GDP, by more than 10 percentage points in emerging economies to 65% of GDP by the end of this year. However, if public finances are to be put back onto a sustainable path, and eventually that, of course, will need to be the case, there will need to be some longer term constraints around fiscal policy. That's likely to include higher taxes and substantial cuts in government spending. Nevertheless, the current theory is, of course, in the short term, policymakers are willing to gamble that doubling down on the fiscal response today will boost the trajectory of the recovery, thus making it easier to repay some of those outstanding markers. What we do know is immediate growth prospects will be determined by the lifespan, the intensity, the geographical spread of the virus. True normalization of activity can only occur when indeed a vaccine has been globally distributed. The good news is, of course, the vaccine outlook has improved. Expectations certainly have solidified that we will continue to see a material improvement, I think, in the healthcare situation in the coming months. 10 coronavirus vaccines have been approved for use in at least one country. Recently, the number of global vaccines surpassed the total number of confirmed cases for the first time. Now 204 million vaccine doses have been administered. Israel, Gibraltar, the UAE have some of the highest percentages of their populations vaccinated. Should also appreciate there's some notable laggards, particularly including countries from the likes of Africa and Latin America. And we should also, I think, recognize there's still a number of vaccine unknowns, including the length of immunity, efficacy against future mutations and possible side effects, global distribution channels, and of course, the impact of vaccine hesitancy, which the World Health Organization has listed as one of the top 10 medical threats. And a reduction in efficacy rates, of course, would improve the road to normalization, negatively impact business and consumer confidence, and hold back the recovery. In terms of our key forecast for this year, we think the vaccine creates herd immunity by the time that we get to the end of the second quarter in the UK and the United States, allowing growth to accelerate. Europe, we think, inches towards herd immunity as we go through the third quarter. I think overwhelming monetary policy support will be maintained to ensure the recovery and the sustainability of debt. Emergency fiscal measures, we think, will eventually taper off as we go through the year. Growth in advanced economies, we think, will underperform emerging market economies as China and India bounce back. I think manufacturing is very much leading the recovery and will continue to do so, particularly while lockdown measures weigh on services in the first half of the year. Inflation, certainly in the short term, will remain subdued. I think longer term there are some risks, and we'll come on to that a little bit shortly. And global unemployment rates will still be significantly above pre-pandemic levels by the time that we finish this year. But 2021 will be marked down certainly as a year of recovery, where we think global growth will come in around 5.9%. Moving on to what we expect in the United States and from President Biden, his victory along with the Democrats' victories in the Senate runoff elections, we think creates a moderate blue wave, but one that will have a significant impact on domestic policy and international relations. Of course, lowering the rate of infections and fatalities, delivering the vaccine, providing virus-related assistance, and transitioning to the post-COVID return to society has to be the number one priority for the Biden administration, and will likely occupy, I think, the majority of the first half of this year. But with full control of Congress, Democrats will be able to confirm the Biden administration's nominees, control the congressional policy agenda with the power to call hearings, and overturn some of the Trump administration's deregulatory efforts. The president, of course, has already laid out this ambitious $1.9 trillion relief plan. Remember, in terms of size, that comes close to March's CARES Act, and is on top of the $900 billion December relief package. Its aim is to control the virus, boost consumption, but also provide support for low-paid workers, for small businesses, and of course, state services. Key measures include for the virus, $20 billion to create this national vaccination distribution program, $50 billion to improve testing capability. Lots of measures in there as you'd expect for workers and the economy. Another round of direct checks to individuals. Was hoped maybe it'd be as much as $2,000. Realistically, I think it's like coming around $1,400 and may not be sent to all individuals. More focused, I think, on lower paid workers who are likely to spend the money rather than save it. So perhaps better news for the economy there. $170 billion to support the reopening of schools, increases in loans and grants for smaller businesses, and a proposal to increase the minimum wage to $15 an hour. Although President Biden has already acknowledged actually that pay hike probably creates too much of a hurdle for the broader package, therefore is expected to be set aside for now. I think realistically, in terms of the size of the package that we can expect, more likely is coming around the $1.4 trillion mark as opposed to $2 trillion, but still significant. In terms of the implementation process, the Biden administration will aim to secure enough Republican votes to bypass the legislative filibuster. If they are unable to gain Republican support, congressional Democrats may use the budget reconciliation process to pass some of this legislation. Remember, this is an expedited process that allows Congress to advance certain tax, spending, and debt limit legislations using a simple majority. Listen, it's right, I think, to say the vice president in the Senate holds the casting vote. But in reality, I think the true balance of power really sits with moderates on both sides of the aisle. And that's something that we'll see play out in terms of policy over the course of the next few years. Of course, the size of the additional package will come at a cost. As a consequence, we estimate the fiscal deficit to increase to more than $3 trillion or 14% of GDP during the course of this year. We know the infrastructure package is also going to be an important priority. Over the course of the campaign and since his victory, President Biden has been arguing for significant infrastructure spending with elements of climate change policy to use his own words, to build back better. Biden said he would focus a large segment of his spending plan on upgrading US infrastructure to make it more environmentally friendly and sustainable. So he's called for significant investment in things like surface transportation, water systems, electricity grids, along with broadband and transit networks as well. Again, probably wouldn't expect the $2 trillion infrastructure package as proposed during the course of the campaign, but we do think a multi-year spending package with bipartisan support can be possible in the second half of the year. We are expecting the Biden administration to implement a more active regulatory approach to enact its policy agenda. So I think from a sector perspective, what does that mean? Well, climate-related sectors such as energy may experience some of the most significant changes. The Biden administration will aim to enforce existing regulations, reverse deregulation efforts, and prosecute alleged wrongdoers. For big technology, and this has been highlighted a lot, and potential change coming through there, I think we're likely to see an increased focus on issues related to anti-competitive conduct, to antitrust laws and enforcement levels. But we do know the legislation faces somewhat of an uphill challenge, but expect enforcement agencies to heavily scrutinize and regulate the industry there. In terms of trade, foreign policy and international cooperation, well, policy proposals and comments suggest the Biden administration will move and pivot back towards this multilateral posture. Biden, we think, will focus on protecting technologies that are critical for US innovation and national security, embracing a policy of competition and deterrence towards China. In the post-pandemic world, mitigating national security related supply chains risk. I think if you look at his national security, his diplomatic nominations, they signal a shift from certainly President Trump's America First agenda. So what does that mean in terms of US growth and the policy outlook? I think the aggressive stimulus package will support immediate growth prospects. We anticipate it will temporarily supplement income and government spending, while the economy, of course, continues to be weighed down by the pandemic. The speeding up of the vaccine rollout should also reduce, I think, new coronavirus cases, help to revive service industry that is particularly sensitive to social distancing, and would help to restore employment back to pre-pandemic levels. So we think the US economy will grow above 6% during the course of this year. We think the unemployment rate will be down back to 4.4% at the end of this year. Despite the faster than projected recovery, we think inflation relatively muted this year before gaining some momentum in 2022. For example, we forecast a core PCE price index to average 1.7% this year, 1.8% as you look through 2022. What does that mean for the Federal Reserve? Well, we know the Fed has aligned its forward guidance with the intention to achieve maximum employment and 2% average inflation over time. You go back to the latest meeting, of course, they kept interest rates unchanged, close to zero, said it would maintain its bond buying program at the current rate, somewhere around $120 billion per month, until substantial further progress towards its inflation and employment goals has been made. They indicated they would look through the temporary pickup in inflation expected in the second quarter due to base effects. There are, of course, still downside risks to the recovery. New COVID variants and vaccination delays may prolong that time to herd immunity. Senate moderates, as we've been talking about on both sides of the aisle, may further walk down some of the stimulus bill measures. But we are expecting, as I say, a positive year from the United States. But we think in terms of policy, the Fed is far from signaling that it's ready to move to exit its accommodative stance. We think, therefore, rates will remain on hold, not only through this year, not only through 2022, but perhaps going deep into 2023. Asset purchase, we think, will continue at the current pace during the course of this calendar year, followed by tapering at the start of next year, perhaps that asset purchase program to finish by the end of 2022. So that's where we are in terms of the US and the Fed. Let's move back to our old friend Brexit, although grabbing less headlines these days will still have an impact, of course, on the UK's growth prospects. We know a last-minute compromise on fishing and the level playing field governance paved the way for the UK and EU to perhaps not successfully, but certainly to conclude a trade agreement. A 5-year review clause offers an opportunity to develop and broaden the agreement. The deal guarantees tariff-free trade on most goods and creates a platform for future cooperation on issues such as crime fighting, on energy and data sharing. The trade agreement thus avoids the nightmare scenario for many businesses where would have seen trade fall back under basic World Trade Organization rules. Such a no-deal scenario, of course, is widely feared by many businesses, thinking it would seriously disrupt trade, potentially create chaos at the borders, possibly even resulting in shortage of essential goods and soaring prices. However, what we should really remember is the UK will still leave the European single market, the customs union, creating not only a hard customs, a regulatory border where goods will face checks and controls, but also exits from the single market for services, which we should remind ourselves accounts something like 80% of the UK economy. So what is the impact of this deal? Remove some of the tail risk of a chaotic no-deal Brexit, therefore seen as positive for UK financial assets and for sterling, and sterling, of course, has been appreciating over the course of the past few weeks. The theory being that the UK becomes investable once again. However, as I said, we should remember, even with this trade agreement, this Brexit is one of the hardest possible outcomes for the UK. It will result in deep adjustments for many businesses and supply chains. Economists, I guess, will look for progress on trade agreements beyond the EU, try and recover part of that shortfall, but that's going to be a very long and difficult road, one would expect. In terms of the outlook for the UK economy, well, over the course of the next few months, we know the UK economy will continue to be weighed down by the third lockdown, which has been extended into March. We've just seen the roadmap of how we'll eventually emerge from that process. And Brexit is a reality, and unemployment, of course, has been rising. The positive that you would point to is the fact the UK government has successfully been rolling out its vaccination programme. It's on target to protect the most vulnerable groups. The UK has been doing something like 2.5 million jabs a week. And when you correct that for the size of population, that's 40% more than in the United States, and it's 5 times the pace that we've been seeing from our European peers. Quite incredible. The Bank of England has said the vaccination programme should support household spending, helping to propel growth to somewhere around about 5% during the course of this year. We do know that there are risks around the UK labour market. We saw from the data this morning, unemployment climbed to 5.1% in December. That's the highest level we've seen in almost 5 years. Beneath the headline figure, the data shows the number of people reporting redundancies still remain high, but has dropped from the peak in September. Total weekly hours worked is still low, but has been showing some signs of a recovery. However, if you look at if you look at the figures from February 2020, 726,000 fewer people were in payroll employment, which is a significant change to the economy. So when you look at the current state of the UK labour market, what does it tell you? Well, the extension to the furlough programme to encourage employers to keep staff on their books. It's estimated something like 4 million jobs are being protected by the scheme. That scheme is due to end, of course, in April. There is speculation that the Chancellor, perhaps as early as next week, will be unveiling plans to extend it yet again. Without that extension, our projections are that the UK unemployment rate will surge above 9% in the second quarter, before improving in the second half of the year as conditions start to normalise. So we expect the UK economy to generate jobs growth in the second half of the year that will see unemployment back to 6% at the end of this year, as I say, and 5.9% at the end of 2022. Although we should recognise that's still substantially higher than the 3.9% pre-pandemic level. In terms of the Bank of England, well, since the start of the pandemic, Monetary Policy Committee has cut interest rates to a record low of 0.1%. They've ramped up that bond buying programme, now stands an astonishing £895 billion. But in the last few weeks, the bank has been offering this more optimistic economic outlook that many economists have been anticipating. And they've also been easing market fears that the introduction of negative interest rates was imminent. Given the vast areas of uncertainty for us, I think the MPC remains on hold, but still very vigilant. They will continue to assess the shape of the recovery over the course of the next few months before coming to a decision. I think if by the middle of the year, incoming data points to slow or stalling recovery, then the Bank of England may still be tempted to consider stepping in to allow the economy to reset on a higher path. If a new monetary easing package is required, I think it's likely to involve a faster pace of asset purchases, more dovish forward guidance, and the last resort, we have to emphasize this, the last resort I think would be negative interest rates. The central bank in the UK gave financial institution members 6 months to prepare for negative rates, but they stressed it's only as a contingency and not a signal of its intentions. If they do introduce negative interest rates, they're likely to be accompanied by lower capital buffers and possibly a form of tiering to try and control the impact on banks' profits. And we should actually remember, of course, the threat of negative rates is nearly as powerful as introducing them without the side effects. And perhaps that's the Bank of England's theory on that one and the policy path that they're really choosing to take. In terms of the UK economic outlook, still remains difficult. I think ongoing virus disruption, rising unemployment that we've been talking about, higher precautionary savings, that thin trade deal with the European Union still creates somewhat of a gloomy backdrop. So I think we're looking at a relatively soft recovery in terms of the UK, forecasting growth of somewhere around about 4% year on year for 2021, which is a poor performance, certainly when viewed through the lens of the near 10% contraction that we saw during the course of last year. Moving on to the Eurozone, well, we know the Eurozone entered its deepest recession since World War II during the course of last year, posting that double-digit contraction in the second quarter. The third quarter recovery, as we know, was led by France and Spain, driven by pent-up household demand, business investment, and net trade. However, the fourth quarter decline puts the Eurozone on track for a double-dip recession. New COVID cases in Europe, as well as elevated levels of virus cases, I say, is continuing to weigh on economic activity there. And the vaccination program has gotten off to a slow start, which means that restrictions in Europe are likely to remain in place for some time, which we think will continue to weigh on the likes of household consumption. There's also signs that bottlenecks in supply chains are now risking disruption to the so far resilient manufacturing sector that we've seen within the Eurozone. Eurozone unemployment, we think, will remain elevated. It was at 7.9% before the pandemic took hold. Workers have been losing jobs at a rapid rate. We think the Eurozone unemployment will finish this year at 9%, remain at elevated levels through the course of 2022, and finish next year around 8.3%. Inflation, we think, remains subdued. There was a pickup in inflation in January. In fact, inflation hit an 11-month high of 0.9%, ending 5-month spell of falling prices. But that was very much driven by one-off factors rather than underlying demand. Higher energy prices, reversal of Germany's VAT cut, all filtering through. And I think when you start to look beyond the seasonal, those technical factors, subdued Eurozone inflation will continue with the weakness that we've been talking about in labour markets and household disposable income anchoring core inflation down at depressed levels. So we think that CPI will average just 1.1% this year, 0.9% in 2022. That's well below, of course, that 2% target level. The European Central Bank have been aggressive in terms of cutting interest rates and providing favourable financing facilities to business and to households to try and help support demand. But the reality is, with rates deep in negative territory, we think the central bank has very limited room to manoeuvre. The burden increasingly sits, I think, quite squarely with fiscal policymakers. And we have seen some improvements there. The establishment of the European Recovery Fund by the European Commission, I think, is seen as a significant step change for the bloc. The European Commission's plans to borrow the money to finance the recovery fund uses guarantees from the EU's long-term budget of security, thereby embracing this concept of shared debt liability for the first time. And that reduces concerns around fragmentation risk within the Eurozone. A timely distribution of the European Recovery Fund is absolutely essential, I think, for the region's growth prospects. Political infighting, poorly coordinated investment policies, and slow progress on commitments to economic reforms risk disbursement delays, and that, of course, as I say, would infringe upon Europe's growth prospects. We think the Eurozone will contract by 1.5% in the first quarter, start to show recovery as restrictions are eased as we go through the second quarter, particularly into the second half of the year. For Europe, we're forecasting full year growth somewhere around about 3.7% during the course of this year. Very quickly to finish off on China. China, of course, the only major region to generate growth during the course of last year, growth of 2.3%. We've seen a strong bounce in activity taking place. Factory output has been the driving force behind the improvement in growth prospects. Industrial production is now back to pre-pandemic levels. Recent data suggests that V-shaped recovery has been broadening out, and we've seen an acceleration in retail sales. Fixed asset investment has been probably a little bit weaker than expected, but property investment has been outperforming despite policies to try and cool the sector. And export levels have improved over the course of the past few months, as major trading partners have lifted coronavirus trade restrictions. We think of China as this manufacturing arena flooding the world with cheap products. But increasingly, China is going to be about domestic demand. I think that'll be good news for the global economy. For this year, I say forecasting strong growth from China, somewhere around about 8.4%. Let me just finish off with some concluding remarks around what we can expect in the post-COVID world. I think out of the woods doesn't necessarily mean back to normal. I think COVID-19 will have many implications for society, the economy, and indeed financial markets over the long run. What does that mean in reality? Well, probably more state. As the world's economy, of course, came to a standstill, governments played a vital role in terms of keeping businesses and households going. The crisis could well result in more permanent government intervention in society and the economy, as well as more regulation. Certainly more debt, fiscal deficits, public debts that we've been talking about today have skyrocketed, as has corporate leverage. The risk of inflation, well, you've got almost a perfect recipe there. You've got recovering activity, you've got ultra accommodative policy, and then you couple that, of course, with rising commodity prices, and there is a risk of higher inflation moving forward. We know we're going to see more technology in our lives. Technology has played this key role in keeping a big part of the economy afloat when most of the world went into lockdown. As we're doing today, more virtual meetings, more working from home, less business travel, less office space, I think will be needed. And that will have ramifications in terms of pollution and productivity over the long run, and could well make people happier as well. So it'll be interesting to see how that development continues to play out. If you listen to the bosses of the technology companies, one thing they tell you is that we've seen much higher rates in terms of adoption over the course of this pandemic. We're probably 5, maybe even 10 years ahead of where they could have expected before the pandemic. And that's, I think, a trend that will continue to play out. So I think it's going to be an interesting time for the global economy, certainly a year of recovery. What's the vaccination program? That's absolutely key to the near term. Watch out for governments maintaining that fiscal response. That's key, of course, to some of our growth forecasts as well. Listen, unfortunately, I think the clock is a little bit against us now, so I will stop here. I do hope that you found this economic update interesting. It's been informative. It's also given you a guide to the outlook for the global economy. So thank you very much for your attention today. With that, let me hand back to Caroline.
Thanks so much, Henk. That was really, really interesting. That's kind of whistle-stop tour, and you've covered off so many different areas for treasurers to think about, things that we'll be following up on over the next couple of afternoons. But yeah, really, really interesting. So thank you very much for those insights. Do stay with us, audience, and join us for the next session, where at 20 past the hour, we'll be talking about the importance of cash management, which obviously is huge. And we've got some really interesting speakers in that session as well. So a perfect follow-up from the introductory keynote from Henk. So please do join us then. And thanks once again to Henk. Brilliant. Thank you.